Hey, welcome back to another Business Broker 101. You know, every business transaction really includes two major decisions. There's the investment decision, do I want to buy the business? And then there's the financing decision, how am I going to fund the business? So in today's session, we'll talk about the questions or topics that a lender will want to ask a potential buyer or borrower of a business. And of course, the first question will be, how much do you need? How much money do you want to borrow? And this is important to start to determine whether the loan will make sense to the bank or the lender, okay? And they'll want to know not just how much you want to borrow, but how did you arrive at that figure, okay? Because there's different aspects of a loan. There could be the business part, there could be the real estate part, there could be credit lines, there could be inventory needs, capital acquisitions to buy equipment, etc. So it's how much and then how did you arrive at that amount. They'll want to see the borrower's credit profile. So there's something called a FICO score, which is an indicator of the credit worthiness of the borrower. And that's a scale from, say, 300 to 850. Obviously, the higher score, the better or more credit worthy for the bank. And it's all about managing risk for the bank. So an 850 credit score is going to carry less risk than a 450 credit score. About 670, depending on the lender, is the line, if you will, between kind of good credit and not so good credit. Okay, and again, the higher you go, the better off. They're going to want to know how you're going to use the money. All right. So I like to think of buying a business in terms of a car. You've got the driver, which is the owner. You've got the car, which is the business. And then you've got the gas, which is the working capital. Okay. So they'll want to know how much the car is and how much gas do you need? How much working capital do you need to make the car run, to make the business run? Of course, the owners switch, one driver switches out the seller and one buyer, the driver comes in. So car, gas, buyer. And when you think of it like that way, you start to understand what the money will be used for. They'll want to know about repayment of the money. So here we're talking about business strategy. What is the experience level of the person that's borrowing the money, buying the business? How confident are they in the borrower being able to repay the money? Okay, what's the historical cash flow of the business? Has it been a consistent performer over time? How long of time has it been? Again, managing risk. So two-year performance is a lot riskier than a 20-year performance or a 50-year performance. The debt service. So this is all about coverage ratio. You'll hear the lender talk about the coverage ratio, which is basically the cash flow of the business divided by the debt service, okay? The amount of the loan, either monthly or annually. And they'll want a certain coverage ratio. Some want a 1.25, some want a 1.50. Again, managing risk, and every loan and every bank and every borrower are different. So debt service, and does the business support the debt service? And also, does the business support a salary and a return on investment for the borrower, right? So it's not just about covering debt. They'll want to know about security. Okay, so these are tangible assets that they can secure, like real estate. Okay, they'll put a lien on a real estate, or if the business has a lot of fixtures and equipment that they could, if something does go bad, that they could liquidate to offset the loan that they're making. Inventory is another thing that they'll look at in terms of security. So again, it's managing that risk profile of that buyer and being able to get comfortable with loaning that money and expecting a repayment. They'll also ask about down payment. So again, this will vary as well. So you can pretty much plan on at least 10% of the purchase price being down, and that's it. Probably includes some real estate, because again, banks like real estate because they can secure it. But without the real estate, you're looking probably at least 20% down. And then the amortization periods, the length of the loan will also vary. So some banks will take a business and a real estate together, 10% down, and do an amortization period of 25 years, which is very favorable because it will lower the payment because it'll be a longer payback time. Without the real estate, you're typically looking at a 7 to 10 year amortization period. Okay, so those are basic questions that a lender is going to ask you when you go to borrow money. All right, so I hope that helps. Again, investment decision, financing decision. These are the questions that the loan officers are going to ask you. So be ready. All right. Thanks for joining us on another video of Business Broker 101. Take care.